Hello, I'm Brent Joyce, Chief Investment Strategist at BMO Private Investment Counsel. It's Thursday, August the 1st. Welcome to our Global Markets Commentary. July was anything but a quiet summer month. Politics, geopolitics, inflation, economic growth, monetary policy, and corporate earnings all had a story to tell. The reactions in capital markets to the shifting and rotating and changing narratives showcased the benefits of diversification. For the first time in many quarters, a broad array of assets contributed to returns. July saw a welcome return to normal, where cash, bonds, and a wide array of stocks contributed to performance. There was significant divergence amongst regional equity markets and across the size spectrum or market capitalization of companies. July was a victory for the well-diversified investor. The changing landscape of the 2024 U.S. election, while featuring prominently in the headlines, wasn't the primary driver of the shifts in capital markets. It wasn't a non-driver, but we don't subscribe that it was the main driver. Politics and geopolitics can move markets in the short term and at the margin, but ultimately, the economy is larger than any individual or party. So, if it wasn't the wild ride in politics driving markets, what was it? We see more evidence that fundamentals drove results, and the fundamentals remain generally solid, which is why many stock and bond markets made gains. Canadian equities were a star performer. The 5.7% return for July alone doubled up their year-to-date performance to 10.3%. So the Canadian equity market sure wasn't worrying about the potential of U.S. tariffs or the scheduled review of the USMCA trade agreement under new U.S. leadership. Canadian equities responded to the economic variables of falling inflation, better than expected GDP growth, and a central bank eager to cut rates further. The standout story for equity markets was the supercharged rally in shares of small and medium companies, companies outside the market darlings of technology and artificial intelligence. The rally in small and medium-sized companies was ignited by better U.S. inflation data. This ushered in the prospect that the U.S. Federal Reserve may soon lower interest rates and by as much as 0.75% this year. July saw a bit of snapback for some of the extremes in the market. With valuations stretched in mega-cap stocks, investors used them as a source of funds to fuel purchases of many other companies. This is a very healthy development. It helps to tamp down the enthusiasm for the large-cap, AI-focused companies whose share prices had run a long way in a short time. At the other end of the spectrum, the Russell 2000 index of small-cap companies, it was trading at the lowest level relative to the S&P 500 since 1999. For those who like to follow the numbers, the S&P rose 1%, while the Russell 2000 small-cap index bolted ahead 10% for the month of July. Sticking with the fundamentals, it wasn't just a love-in for small caps. Adding to the selling pressure on the large-cap tech names were disappointing earnings outlooks from Tesla, Alphabet, and Microsoft, where even meeting earnings expectations wasn't good enough. Questions are being raised on how much companies are spending on AI research and rollout versus how much and when those investments may generate revenue. Beyond the underwhelming earnings of selected large-cap names and the punishment handed to their share prices, earnings season has generally been fine, and earnings forecasts for major markets that have been on an upgrade trend are holding steady for this year and next. The bottom line, some companies were priced for perfection and paid the price of mild disappointment. Others, whose shares offered greater value and delivered or beat expectations, saw their share prices rewarded. That is precisely how things should work. July's market activity supports our soft landing Goldilocks base case scenario. This rotation needs a soft landing. If this Goldilocks soft landing were in question, the riskier small cap companies that are more leveraged and more reliant on bank lending than borrowing in the bond market, well, they wouldn't be rallying. The broadening out of participation across geographies and market capitalization reinforces this view. Corrections in equity markets are a normal part of investing, and the fact that pockets of overvaluation saw weakness and other areas strength is good news. We are in the volatile, low attendance, low liquidity part of the calendar, and more rocking and rolling may lie ahead. With November 5th fast approaching, election speculation will garner headlines. Beware of those making connections between political rhetoric and movements in capital markets. Promises from any politician, especially those made on the hustings, must be taken with a large grain of salt. Rhetoric is what a candidate would like to do. It often has little connection to what can actually get done. The overwhelming weight of historical evidence points to capital markets being driven primarily by economic outcomes, not political ones. That's the way we saw the month of July. Thank you for joining us. We look forward to you tuning in next month.